when should a company think about revenue-based financing? Because like you said, if you can get bank financing, you should absolutely go the bank routes, right? So when should a company think about revenue-based?
Can I get on my soapbox for a second? So companies really need to have a capital strategy. And you'll hear me say this over and over. When companies are out there and they're new, they're probably hearing, oh, go get equity investors, go get investors, or go get bank financing if you can. But companies, at least from the ones that I've seen, they're not necessarily sitting down and saying, okay, I've got a go-to-market strategy, I've got a hiring strategy, I've got a manufacturing strategy, but I don't have a capital strategy. And I think that there are so many options out there that companies need to look at and not just pick. Nothing is a one-size-fits-all. And throughout the life of a company, different sources of capital will make sense at different times. So we're not here saying everybody should go get revenue-based finance, because that doesn't make sense. Obviously, you have to have capital and revenue to be able to pay us back. And equity financing in some cases is way more suitable for what you're trying to do. But that doesn't mean that you shouldn't plan to maybe take advantage of all these at some point. So anyway, I'll shut up now.
Well, that's good, because for our viewers and fans, there is a video on capital strategy, which Denise will be a part of.
No, so I think for your question, like when do you take it?
Mm-hmm.
I think it's, you have revenue, you've gotten your product market fit, and you want to grow. You want to see that like exponential growth curve start happening, but you don't necessarily qualify for bank financing, because manufacturing is a little bit easier to get bank financing because you do have assets, but a lot of the companies we talk to don't really have true assets to back their bank financing. Or you don't want to take equity because the pricing, what your pricing is going to be so much that the dilutive impact to you is going to be more than you're willing to bear. So this kind of really can help people get to that round of financing where they have a much better leg to stand on with the investors and to say, hey, I've got true revenue, I'm on a track to profitability. So my equity is worth a lot more, and so you have to give me better pricing for it.
Mm-hmm.
We saw that a lot at Lighter between Series A and Series B,
Mm-hmm.
where we're aiming at Sage is between seed and Series A, so in that area.
Okay, so this is something then a company could take advantage of in tandem with another financing vehicle. Like they could do revenue-based financing as well as raising the round of equity at the same time.
That would be, in our portfolio, probably the most common capital strategy of the companies we invested in is they have all raised equity capital.
Mm-hmm.
And now they, as Molly said, they need more cash to accelerate their growth. They're not yet bankable. Their alternative is to return to the equity markets and raise more equity capital or sell stock, if you will. But doing that, of course, dilutes the entrepreneurs. And so often and it dilutes the previous investors too, so often it's the existing investors that bring a deal to us and say, I invested in this company, I'm excited about it, they need more cash, and while I could put it in, or others could put it in, it's dilutive to everyone, would you all be interested in making an investment in this to accelerate their growth? So we love those kinds of deals.
What type of companies should not think about revenue-based financing? Like what are not good fits for you guys?
Pre-revenue company.
Obviously.
Not yet, right?
Yeah. They do actually have to have revenue, or there's no way for us to underwrite the investment. We have to have revenue that we can see a history on it. And I'm the guy that often talks to the companies that first approach us, and that would be the most common thing that we have. I got this really great idea, I just need some money. Well, that requires equity. That's an equity investment in the capital strategy. I've got revenue, I understand my market, I have product market fit as Molly said, and I understand how I can deploy the cash to grow the sales. Now this type of capital can make sense.
Your balance sheet needs to be in order, and you need to actually have financials. I know that sounds like a crazy thing, but like you need to be producing monthly financials. We can't make an investment in companies that don't produce monthly financials. It's just from our own ability to check their revenue and or going forward, making sure that everything is aligning appropriately.
Mm-hmm.
And as Molly said earlier, companies that are elephant hunting, their customers, are one large deal, and then the next one large deal. Those are really not. They're really not a good fit for this.
Okay.
Or people coming to get money to pay off previous debt. So a lot of that has to do with what do they need the money for. It is a huge influencer for us.
Okay, so let's talk about criteria, or what does a company need to have in order when they come to you guys? Like, they have to have, I'm assuming, a certain time period of financials or revenue. What do those kind of things look like?
Yeah, so we look for at least 18 months worth of financials and 12 months of revenue, being like actually having producing revenue from customers. You need to have gross margins over 40%, which is probably important in the manufacturing space, because if we're going to take a percentage of your revenue, we don't want to really ding out the bottom line too much. You need to have some sense of profitability, or how you're going to get to profitability. You don't need to do it with our financing, but we'd like you to understand like how you would do it if you needed to. Those are kind of the big things. We're going to look for monthly financials. Both balance sheet and P&L are going to be a requirement for us. Cap table, you have to have your corporate docs in order. Those type of kind of basic things that anybody who's going to make an investment in you is going to ask about. Expect us to ask about it as well.
Our minimum thresholds too. So she mentioned the 40% gross margin. We're also looking at previous 12 months revenue of at least $300,000.
Okay.
So we will invest up to a third of the previous 12 months revenue, and we don't want to do any less than $100,000 deal. Therefore, $300,000.
It's nice to see some angel support in there, like Kevin was mentioning. It's nice to know, because we don't take board seats. We're not going to do your corporate governance for you. We will be helpful if you have questions. So if you come and say, hey, I'm having this problem, do you have any suggestions? How can you help? We will totally be helpful about that, but we're not going to be proactively sitting there telling you how to run your business. And so sometimes it's helpful for us to see that you do have a good board of advisors or people who are going to proactively be helping you with your business, because it's nice for entrepreneurs to have sounding boards and to have other people kind of providing them with insights and introductions, etc. So that's something that we do also look for. But I will say, like, having your financials in order is like a very, very important part of it, right? I mean, if you don't understand what your financials are and you get on a call with me and I ask you, like, why is this loan payable on your balance sheet? And you say, I didn't know I had a loan payable on my balance sheet. Like, that's not a good sign. It's not, like...
It happens more often.
It happens more often than you'd think. And as an investor, that makes us not want to invest, because it signals to us that you don't understand how your business is actually operating. And as an entrepreneur, you really should understand what all the levers are within your business that make it work. What is the gross margin that your product is running at? What does it take to get to break even on that one product? What do all those things look like? You should have a good understanding of that. See, the other thing that we don't like to see is heavy customer concentration. So just having one customer can be very problematic.
So revenue-based financing serves a definite purpose in kind of like the life cycle of the company, right? Because a lot of times, even if you are bankable, you have to provide a personal guarantee or something like that. So can you maybe walk me through when a company in their life cycle should look at revenue-based financing, and then what does the next step look like after something like that?
So I think you look at it as you get that product market fit, and you say to yourself, whether I want to take bank debts or not, whether I want to do the personal guarantees. I think after revenue-based financing, it really depends on what type of business you want to have. So do you want to have a lifestyle business in which you're just running this for your own family and for the cash flow that it throws off? Or are you looking for something further, an exit, a merger, etc.? If you're looking to run a lifestyle business, after revenue-based financing, you've probably hit the point where you are bankable without that personal guarantee. You're probably pretty close to profitability or at profitability. And at that point, you've got enough financial back there that the bank will take a look at you and will underwrite you accordingly. If it is like, I want to be acquired or be the next Airbnb, I used to say Uber, but I don't think that's appropriate any longer, the next Airbnb, then I think that's where you go out and you find, that next round, whether that's your Series A or your Series B or wherever you are in the cycle. Obviously, in the current market, there isn't a lot of that to be found, but that's probably why revenue-based financing is a good fit, because we can get you to that point and help you potentially grow through this kind of desert in VC and angel investing.
Nick, I might say, mean, we obviously, the three of us are very comfortable talking about this because this is the business we're in, but it's a relatively new, unusual form of capital. And so I would invite any of the listeners, if you're interested in figuring out whether this might fit you or not, give us a call, send us an email. I'll talk to you. Within 15 minutes, we can make a decision whether this may or may not be appropriate for your business. That doesn't mean we can make a decision of whether we would invest 15 minutes, but I certainly can say, not yet, or you need these things, or guys, this looks like it might fit, you ought to send an application to us. So we invite people to communicate with us. And it's also appropriate if you think you might need this financing down the line to start a relationship. I mean, we're a small venture capital firm, and all VCs invest based upon relationships and people they know and relationships that they have created. And so we have a number of companies that we've talked to where we said not yet, or they may have said not yet, and they're in communication with us and we're following them. And when the time comes that this capital could be appropriate, that makes it much easier for us to make a decision, make a favorable decision.
I'll also say we have a great website, and the resources page on there has tons of different information about revenue-based financing, but also other options that are out there, blogs we like, that type of thing, that if you're trying to figure out what is happening in the world of angel and revenue-based financing in VC, there's a bunch of stuff on there that you can kind of read about or listen to or whatever works for you.